This is Trade Flow News, bringing you relevant news and insights from around the world. Trade Flow News, enabling trade for SMEs and economies worldwide.
Welcome back to Trade Flow TV. You know the drill. Markets move fast, and if you're not ahead, you're under. Yesterday, global trading desks tried to celebrate a historic relief rally built on a fragile Israel-Lebanon truce. Today, the physical reality of the war zone has violently shattered the paper peace trade, while currency and interest rate desks brace for massive central bank shockwaves. Let's get you caught up for the global open. First up, the 60-second global macro flash. The truce is shattered. Despite the recently announced truce, Israel launched renewed strikes on Lebanon, crushing international hopes for an immediate cooling of the wider war and a swift reopening of the crucial Strait of Hormuz. Brent surges back. Energy futures reacted instantly to the kinetic escalation. U.S. crude futures jumped over 2.3% to trade at $92.64 per barrel, while global benchmark Brent crude surged 2.5%, reclaiming a firm foothold at $95.42 a barrel. Fitch Ratings explicitly notes the baseline will remain highly squeezed between $100 and $110 through July unless Hormuz clears. The euro cracks its recovery. The EUR/USD cross has fractured its recent consolidation ceiling, slipping lower to trade in the 1.152 to 1.160 range. The ECB has directly highlighted that severe energy import dependency continues to place a heavy macro tax on the Eurozone. The ECB is locked into a policy shock. For the first time in 2.5 years, the ECB is poised to hike interest rates. Ahead of this Thursday's June 11th policy meeting, markets have priced in a near certain 97% probability of a 25 basis point increase, lifting the key deposit rate from 2.00% to 2.25% as inflation spikes. Finally, bond par yields extend. High inflation anxiety is bleeding into sovereign debt tracking. The 10-year Eurozone central government bond par yield has pushed up significantly to 3.39%. Trading drastically higher than its long-term average of 2.51%. Let us take a deep dive into the geopolitical bull trap. The data hitting global terminals this Tuesday morning proves that you cannot manage a macro portfolio using political rhetoric. The world is locked into a physical resource war, and central bankers are running completely out of exit doors. Yesterday's initial trading drop below $100 crude was a classic sentiment trap. Algorithms blindly chased headlines of a diplomatic truce, assuming shipping corridors through the Gulf would instantly reset. But physical choke points do not trade on paper promises. The immediate renewed strikes over the weekend confirm that the primary route for nearly 20% of global oil transit remains heavily bottlenecked. The EIA continues to project massive physical draws averaging 8.5 million barrels per day for Q2, setting a brutal floor for global manufacturing overhead. This traps the ECB. This Thursday, Christine Lagarde has to execute an emergency insurance hike. Eurozone consumer price inflation accelerated to 3.2% in May, heavily driven by the Middle East energy shock, pushing far past the bank's 2.0% baseline. The ECB Governing Council is practically forced to raise the deposit rate to 2.25%. They are moving into a recalibration phase, raising borrowing costs directly into a cooling, negative growth manufacturing backdrop, because letting long-term inflation expectations break is no longer an option. This explains the Euro FX and yield disconnect. The EUR/USD struggling beneath the 1.16 handle tells you everything about the capital flight out of oil-importing economic blocs. European corporations are burning raw capital simply to maintain basic logistics and inputs. While the euro area has successfully captured significant international debt issuance over the last year, raising domestic interest rates by 25 basis points cannot magically print physical barrels of crude to fix a broken trade balance. With the 10-year Eurozone par yield climbing to 3.39%, fixed income markets are screaming that higher-for-longer inflation is structurally locked in. Here is the trade flow take. The brief window of diplomatic optimism has officially slammed shut. The ECB's imminent rate hike this Thursday will place severe downward pressure on overextended equity valuations and cyclical sectors. Use this immediate spike in crude to solidify your exposure to hard, tangible energy assets. Ensure your foreign exchange hedges favor maximum dollar liquidity protections and avoid catching the falling knife in European growth indices. Stay liquid, stay sharp. See you on the next one.
That is all for today's news on commodity markets. Stay tuned to Trade Flow News as we continue to provide you with more updates. We also invite you to follow us on Twitter at TradeFlow News, which allows you to watch our program on your mobile device or desktop to receive information from there.